All right, welcome everyone. It is 3 o'clock Eastern, which is thanks for joining. For those of you who are regular attendees, thanks for joining us on our different time. We'll give it about one more minute before we officially start. So if you need to run to the bathroom or grab that cup of coffee, please do so now, and we'll get started pretty soon here. All right, let's go ahead and do it. My name is Matt Moore. I'm a business development manager here at Camaplan. And once again, thank you very much for joining today's webinar. We're very, very excited to have Rob and Clay Stanley here from Shining Rock Equity. Before we get started, just a quick housekeeping item, which is our disclosure. Got to make the lawyers happy. So today's presentation is for educational purposes only. This is not meant to be any kind of advice or an endorsement of any particular asset. We encourage you to go and seek out the correct counsel and advice from those appropriate professionals before making any kind of investment decisions. And if you have any questions about how to get started with a self-directed IRA or want to have questions about your existing self-directed IRA with Camaplan, please don't hesitate to reach out to us at that email address or phone number that you see in front of you. And then the last item, another housekeeping tip, is that the chat will be disabled during the presentation, but if you have a question, they're highly encouraged. Please use the Q&A portion of the Zoom portal, and we'll answer those questions at least by the end of the presentation. So without further ado, I'm going to turn it over to you, gentlemen.
All right, give me 1 second here to share my screen. All right, so everybody got that?
Looks good.
Okay, great. All right, well, let's get started. Hi, everyone. I'm Rob Stanley, managing partner at Shining Rock Equity, based here in Chapel Hill, North Carolina. I am proud to be here with my son and business partner, Clay Stanley. Thank you all for tuning in today, and I'd like to thank, excuse me, I'd like to thank Matt for inviting us to present on today's topic, how to evaluate private real estate deals. We'll share how we break down a deal and what we look for. The hope is by the end, you'll feel more confident asking the right questions, spotting red flags, and making good decisions. We'll be sure and save some time for Q&A, as Matt mentioned, and we'll also tell you how to download our due diligence checklist as well. I'll start with a little background on myself, the team, and Shining Rock Equity. So I've been in real estate for close to 30 years. And over that time, I've worked with institutional investors in acquisitions and portfolio management. A few years ago, we created Shining Rock Equity to facilitate making our own investments, and soon realized we could also help others in our network access high quality investments opportunities as well. To date, we have partnered with main sponsors on 5 single asset multifamily deals representing about 900 doors, along with 1 private credit fund. Across these opportunities, over 50 investors from our network have joined us, and many of them coming back as repeat and even some 3-time investors, something we're extremely proud of. In my role with Shining Rock, I focus on day-to-day operations, compliance, developing partnerships with operators and investors. Before I turn it over to Clay, I'll mention our other 2 team members. Kim Solomon, my sister-in-law, who is a top producing residential agent here in Chapel Hill. She's a true master connector of people, and as such, she's a perfect fit for her role in investor relations here at Shining Rock. Also, we have my wife, Sarah, on the team. She has her own graphic design company, S Squared Design, and she oversees our marketing efforts. So as you can see, we really are a family business. And with that, I'll turn it over to Clay.
Sure. Thank you, Dad. And first of all, just want to thank everyone for tuning in today. Hopefully, we can add some value to you. I'll start with some brief background on myself. I started my career about 5 years ago doing single family acquisitions for a firm based in Charlotte. And this firm, we handled the acquisition process for two different large private equity clients. Got to the point where we were purchasing 200 to 300 homes per month, and I handled about a third of that volume. Now, when interest rates rose, those private equity shops sort of paused. It continues to be slow on that end. And so, for that same firm, we buy land and build homes. And I handle much of the land sourcing and underwriting process for that vertical. And really, on both of those verticals, I'm very much on the financial analysis side, which is part of what I bring to Shining Rock Equity. In addition to that, I also make sure that we have a constant flow of quality deals that we get to evaluate from sponsors and handle some investor relations tasks as well. I'll go into a little bit about what we're focused on today. And we're, as I mentioned, focused on sourcing great deals from strong operating partners with a pretty intense focus on North Carolina, although we do have some good operating partners in Texas as well. And these operating partners specialize in their particular market or strategy. And when they put a deal under contract, they come to a group like ours and ask if ourselves and our investor community want to join them on that opportunity. That's when we go through our due diligence process. We really only do 2 to 3 deals per year. We want to bring the best quality deals, obviously, for our own investing, but also bring those deals to our investors. For us, our main concern is the underwriting and understanding of each risk within any given project and the likelihood of those risks actually taking place. The more risks that we can underwrite and understand and see the appropriate mitigation of those given risks, the more comfortable we can feel with any given project. And with that, we can move to the next slide and get into why evaluating private real estate deals is relatively challenging, especially for new investors. I think it starts with sort of a lack of knowledge or limited real estate background, and they might be extremely competent and high performing in their given industry, but that doesn't necessarily translate into real estate. And then more so than that, there's a knowledge gap between the person that you're investing dollars with and your level of knowledge, especially as you begin. And so, just for an example, a sponsor might present a deal to you that's showing 5% rent growth in Austin, Texas, and you might think, oh, well, Austin, Texas, that's a high growth market. That seems reasonable. In actuality, looking at the data today, that's nowhere near reasonable. Austin rents, I currently live in Austin, which is why I chose this market to give an example on, but Austin rents are down 20% in the last few years. So it's struggling with oversupply, but you might not realize that if you're not in the market every single day like a sponsor would be. Sort of in addition to that, you have a lack of transparency. Being that it's private markets, there's just naturally opaque aspects to this. And you have both reputable sponsors and non-reputable sponsors or bad actors. And bad actors doesn't necessarily mean people are or a lot of people are out there committing fraud. It could just mean that they're not good operators or they're doing deals for the wrong reasons to generate fees. In addition, you have a lack of learning resources, and a lot of the learning resources come directly from sponsors. Even the information you're getting today is from someone who partners with investors on deals. And so you just want to make sure that you're investing with people who are going to give you the full picture and full transparency before, during, before and during a deal. There's plenty of great sponsors out there, and there's plenty of sponsors who don't necessarily give the full picture. So you just want to understand who you're investing with from that perspective. And then the barriers to entry, these have relatively high minimums. So it's not like, you know, with any given stock investing, you can go invest $1,000 and see how see how it turns out. For these, you're investing 50, 100, $250,000. And so the price to learn is relatively high. And so that's another challenge with this type of investment. And then this sort of goes back to point number one, but the limited access to quality deal flow, and then understanding what a good deal actually looks like. Um, every sponsor is going to frame their deal in the best light, and so every deal might look like a good one when you're first starting out. So it's just something to note. The more deals you can lay eyes on, the more you can understand the private market real estate marketplace in general, and it'll help you make better decisions. I think one of the best places to start is actually not looking at anything external, but more looking internal. I think you have to understand your own risk tolerance before evaluating deals in general. You'll want to understand how you feel about things like illiquidity, how you feel about hold times, and where you are on the risk spectrum. I like to ask investors on a scale of 1 to 10, 10 being Bitcoin and 1 being US Treasuries, where are you on that level of risk or on that risk spectrum? And then it also goes into your goals. Are you looking to preserve your capital, aggressively grow your capital, or generate income with your portfolio? Depending on what your goals are, what combination you're looking for will depend on what kind of opportunities you should be seeking. For instance, if you're looking to generate income, you don't want to go do a development deal. And sometimes if you don't set those parameters up front before your search, you might get shiny object syndrome. So I think it's important to define these when you're first starting, or even if you're well along and experienced within this type of investing. Now, looking at sort of what investors get wrong sometimes, I think for a long time people thought that the worst thing that happens when you invest into these types of projects is that you just get your capital back, your principal investment. Maybe you don't make a great return, but that's simply not the case. You can lose 100% of your capital in these investments. They're higher risk than going out and purchasing a single family home yourself, mostly due to the debt structure, which we'll get into here in a few slides. Generally speaking, you're not seeing 30-year hold periods for this type of investment. And so, that hold period and the level of risk have a lot to do with one another. And then the nature of due diligence in general, the fact of the matter is there's really no perfect checklist. And so every deal is about building out the full picture, gathering as much information as you possibly can, because every deal is going to have different nuances that you need to take into account. And at the end of the day, trust with the sponsor is going to be a core ingredient here throughout the entire process, and something that is absolutely essential when investing into private markets. And then looking at why relying heavily on projected returns can lead to underperformance. When Rob and I look at a deal, our first 20, 30 questions that we're asking ourselves or asking a sponsor are all around downside risk. And that's because projections at the end of the day are just projections. Underwriting, we can change a few numbers in an underwriting spreadsheet and it can show a drastically different return. And so it's important to understand the assumptions behind those projections. And if you're filtering deals based on the projected return, I think that's the wrong way to go about it. Of course, that's something you need to take into account, but I would be filtering deals based on certainly your goals, and then the level of risk you feel each project is taking on, and the level of return you feel like you can achieve for taking on that risk. Not only that, but IRR can be misleading for a number of different reasons. It does take into account the time value of money. So a very short-term hold period is going to show a drastically higher IRR than a longer term hold period, even though that longer term hold period might be a better deal at the end of the day. And then some critical assumptions to scrutinize when you're going through an underwrite, when you're going through and evaluating a deal. And I picked these assumptions because they're some of the most, or they impact the returns in a relatively volatile way. By moving the rent growth or by moving the exit cap rate, the return projections can move drastically. So it's important to understand how feasible or how plausible the rent growth is in any particular market for any particular property, and then how that relates to expense growth. One thing that I don't necessarily love is when I see a sponsor project 4% rent growth, which is already high to begin with, but then 2% expense growth. And I really want to see those numbers be a little bit closer at least. And then looking at exit cap rate, the issue, this is probably the most volatile assumption when it as it relates to your returns, and it's probably the hardest to predict as well. When we're looking at a 5 or 7 year hold period and trying to determine an appropriate exit cap rate, we're trying to understand what the macro level economy looks like at at that time of sale. And even full-time professional economists can't predict the future, and exit cap rates have a lot to do with the macro level economy. So it's very hard to predict, and you just want to make sure that it's uh, relatively conservative or at least plausible that you'll be able to sell the deal at that particular exit cap rate. And then if you're doing some sort of value add plan and you're looking to raise rents 100, 200, $300, you want to make sure that those rents are actually achievable. And then this next one here is less of an assumption and more of just an analysis that you need to do. And that's looking at your leverage. Leverage amplifies outcomes. So the higher leverage a deal has, if it goes well, the returns are going to be great. The returns are going to look great on a spreadsheet. But at the same time, the higher leverage a deal has, more than likely the higher the risk there is on that deal and the higher the chance of that deal going to zero. And so it cuts both ways, and you'll just want to pay attention to that on every single deal that you're evaluating. And then again, less of an assumption here and more of an analysis, but you should be looking at what happens if your rent growth is 1% and your exit cap rate is a basis or 100 basis points higher than what you initially projected. You want to see what happens in those downside scenarios and see if you're okay with that kind of reasonable worst case scenario. And so do that with your rent growth and exit cap rate, do that with expense growth, do that with your pro forma rents. You want to stress the underwriting and make sure that those downside scenarios are something that you can live with. Um, and that'll help you make better decisions as you evaluate these kinds of deals. And then the largest source of risk in any private deal, as I alluded to earlier, is almost always the debt. And the first thing you want to do is make sure that the debt actually aligns with the business plan. For instance, if you are looking at a stabilized property where there's not much upside and the sponsor wants to put bridge debt on it, I would start asking a lot of questions. Bridge debt should be used when there's sufficient value that can be added. And even then, it's still not comfortable for many people. And so that's just an example, but you want to make sure that that debt product that's being used aligns with the business plan and the hold period as well. And then you want to understand the debt service coverage ratio. This ratio tells you, for instance, for every dollar of NOI, and if you have a dollar of debt service, that's a one DSCR. And so the higher the DSCR, generally speaking, the lower the risk. But that doesn't mean that a deal that has a low DSCR is a bad deal. It just means you have to create a lot of value to get that DSCR up to a respectable level. Sometimes that's good, sometimes that's not good, and it depends on the project to determine which that is. You want to understand, as I mentioned, leverage, and not only leverage at time of purchase, but also can the deal or can the is the loan going to fund capex dollars? If it's going to do that, then the leverage is going to increase throughout the initial part of the hold period. And so that's another thing to note. That's going to increase the leverage on a deal if you can fund capex through additional loan proceeds. Sort of touched on this earlier, but fixed versus floating rate, you'll want to understand if it's floating, do you have a rate cap? If it's fixed, what does the prepayment penalty look like? So you want to understand the nuances around the type of debt that is being used.
All right. Thank you, Clay. I'm going to jump in and talk about the sponsor or evaluating the sponsor. Um, so the first step is examining a main sponsor's track record. When you look at their past performance, the numbers might look impressive, but numbers alone don't tell the full story. You'll want to dig into when those results happened and how they were achieved. Some sponsors saw great returns during the boom years when rates were low and cap rates were falling leading up to 2022. And that's great, but the real question is, would those same results hold up in today's market? Be sure to look at performance in the context of the economy at the time of the hold period and the exit. Then dig into NOI growth. If someone tells you their NOI went up on a deal, don't stop there. Find out why. Was it from improving operations, cutting expenses, or making smart upgrades? Or was it simply because rents were rising everywhere? Um, this means being able to separate skill from market lift. Not all growth comes from skill. Some of it is just being in the right market at the right time. Figure out how much of their success came from things they directly controlled versus gains from a hot market. That helps you predict how they might perform when conditions aren't as favorable. You'll also want to consider alignment of interest. One of the biggest things to look for is whether your interest and the sponsor's interest are truly aligned. Incentives, excuse me, incentives drive behavior, so it's worth looking closely at how and when they get paid. So that means understanding fee structures. Take a look at all the fees, acquisition, asset management, refinance, disposition, and so on. Are they reasonable for the work being done? And ideally, are they tied to performance rather than guaranteed no matter what happens? Ask if the sponsor gets paid up front regardless of the outcome, or if their compensation depends on the deal actually performing well. The more their payday depends on success, the better off you are. And finally, look at shared risk. True alignment usually means the sponsor has real skin in the game. Are they investing their own money alongside yours? If so, that speaks volumes about their confidence in the deal. Now let's talk about some red flags to watch for. Over the years, we've seen some deals that checked almost every box until we spotted a few things that didn't sit right with us. These are the kinds of red flags that can turn a promising deal into a costly mistake. So first, check for excessive acquisition fees. If there's a big chunk of money going to a sponsor on day one, it could be a sign they're more focused on getting paid up front than delivering value over the long haul. Typically, and this depends on the size of the deal, we see acquisition fees ranging from 1 to 3% of the sales price. Higher than that, and it's likely excessive. Next, see if the sponsor is entitled to take a disposition fee. At the sale of an asset, this is essentially an extra fee, one that can be excessive if the sponsor is already being compensated through performance splits. Next, the word guaranteed. Almost nothing in private real estate is guaranteed. And if you see that word, it should immediately raise your guard. Then look for a clear explanation of capital sources and uses. A good sponsor should clearly outline exactly how every dollar will be spent, both in their investment presentation and in the legal offering documents. If it's not crystal clear where your money is going, that is a red flag. Finally, is there a lack of transparency? If a sponsor avoids questions or provides incomplete materials or makes big promises without backing them up with data and conservative projections, that's usually a sign of either misalignment or inexperience. Um, Before I go over some of the key takeaways, I invite you to download our due diligence checklist by using the QR code shown here. So a few key takeaways. Know your risk profile, like Clay mentioned. Start with a clear understanding of your own goals, time horizon, and how much risk you're willing to take on. Don't don't rely solely on projections. Projections can be manipulated to look great. Instead, focus on the assumptions that drive them. Dig into the details. Look at the debt terms, break-even occupancy, how CapEx is funded, and other factors that impact risk. Look beyond the boom. A track record from easy market years doesn't always mean the sponsor can perform in tougher conditions. Trust but verify. In this business, that means checking the numbers, the assumptions, and the alignment before you commit. And finally, ask the right questions. A disciplined, repeatable approach to due diligence is really your best defense against bad deals and unnecessary risk. So with that, that's sort of the big picture on how we look at deals. We can open it up for some Q&A.
Yep. Happy to answer any questions as they come through.
All right, thanks a lot. That was great, guys. I actually have a couple questions myself, if
Okay.
just to get things started. Um, and just a little bit about why I'm curious about this is because I used to work for a hard money lender myself. So Clay, especially your portion talking about the financing of the deals really was of interest to me. On the on the topic of underwriting and how you said to use your word, underwriting can be massaged. Where do you see that massaging kind of happening most often with sponsors?
Yeah, I think, one of the ones I mentioned there was rent growth. That's an easy metric to massage there. And the difference between 2% rent growth and 4% rent growth on any given deal can be massive.
Hmm.
And so that's a place where you see it. Another place is exit cap rate. Again, that's hard to predict, but what you definitely don't want to see is that someone is assuming cap rate compression. Now, if you see that and you're okay with that risk, then by all means, but you should at least recognize that they're assuming the market is going to be better when they sell the deal than it is today when they're buying the deal. And cap rate compression is just if you're buying a deal at a six cap and you're assuming it's going to sell at a five cap, that's cap rate compression. That's very aggressive. And so, generally speaking, we want to see the exit cap rate be equal to our going in cap rate,
Hmm.
or see some, expansion there, maybe 50 basis points or 0.5%, depending on the deal profile.
Okay, great. Um, and then the other question I had, if you'll, humor me, is you talked, Rob, you talked about the disposition fee. It's like hardly ever justified. When are there instances when you view it as being justified?
I've
That's
got some
tough.
thoughts on
Go
this one.
go ahead, Clay. Go ahead and take that one.
Okay. So when it is justified, disposition fees are relatively common. I see them quite a bit, and I don't love them, but if someone is going to charge a disposition fee, I think it should be subordinate to the preferred return, meaning they can charge their disposition fee as long as it's reasonable, but at least let the LPs get their preferred return of 7, 8, 9%, whatever it might be on that particular deal. What you don't want to see is a deal go poorly and they still take an acquisition fee, even though investors have received a low single digit, or I think I said acquisition, or they still take their disposition fee, even if investors see a low single digit return. That's not something that I'm okay with.
Got it. That makes sense. So it's really like there's maybe a more justified structure for that fee rather than just a singular reason. Okay,
Exactly.
great. Thank you very much. So a couple other questions I have for you that came in is which assumption is riskier to get wrong? Rent growth, the amount of debt, or the exit cap rate?
Yeah, it depends on how wrong you are on each one, but all of those are gonna affect the deal differently depending on the profile. Um, I would say what you want to solve for and what you want to see is are assumptions that are plausible, that are relatively likely to happen, and you can find this through just online research. With AI now, it can do a lot of the legwork for you as far as due diligence goes. So just start researching markets, start looking at projections for different markets, and you'll very quickly see if something is plausible or not. Um, I would say, one thing that I always say is that the projected returns and the assumptions are 100% going to be wrong. Nothing ever goes exactly according to plan, and so what you want to do is see what happens if those assumptions do not come to fruition. If you think a market's going to return 4% rent growth and it ends up returning 1% rent growth over 5 years, how badly does that affect your deal? And are you okay with that outcome? That's sort
Okay.
of how I would answer that question.
All right. Excellent. And then another question I have for you is there such a thing as being too conservative in your underwriting, or does being conservative always work in your favor long term?
I think you have to be as conservative as you can be. But at the end of the day, it is a competitive marketplace. These deals are being looked at by usually more than one person. And so ideally, you're as conservative as possible. At the same time, you have to be able to win deals and you have to be able to um, be in line with the person you're competing with. And so, what you want to see are plausible projections. Now, are we or is anyone else ever going to win a deal if they're projecting 0% rent growth over the next 10 years? No, they're quite frankly just not going to win a deal. So, you want to just make sure your assumptions are plausible, and see what happens if they don't come to fruition, and are you okay with that kind of outcome?
Okay. Um, Another question. It says you mentioned something along the lines of that you are concerned when rent growth is projected higher than expense growth. Are you suggesting the growth rate for both should be similar in projections?
That's exactly right. I see a lot of, we're actually evaluating a deal right now, and went through the underwriting, and the sponsor was projecting 3% rent growth and 3% expense growth. Generally speaking, that's how I like to project things. They generally will rise at the same rate. Actually, I just saw some research that showed over the last 10 years, the expense side of multifamily real estate was growing at an average of like 4.28% per year. And I doubt very many people projected 4% plus expense growth. So it varies, but I definitely don't like seeing a huge discrepancy there. I don't want to see 5% rent growth and 2% expense growth or anything like that.
And when you touched on that earlier in your presentation, that kind of uh, raised my eyebrows too, in addition to the participant here who asked the question. So kind of a one for one is the ideal relationship. Is there a range, where it's if you had 4%, you'd allow for 3.5% on expense growth, and anything lower than that, you would say that's kind of in the danger zone, or is it really just one for one?
Yeah, I mean, I think one for one is ideal. I'm not gonna immediately. It's not like a red flag if I see 3% rent growth and 2.5% rent growth. But I want it to be within that range,
Got it.
and so somewhere within a percent at the maximum would make sense for me.
Okay, awesome. Well, those are all the questions that we had. So with that, any closing remarks you'd like to say as we near the end of this thing?
Yeah, well, first of all, thank you for tuning in, and we're always available if anyone would like to reach out. We're happy to go more in depth. We'll even underwrite some deals that aren't ours to give you a little head start. I do encourage you to download our due diligence checklist. And again, Matt, thank you so much for having us on.
You bet.
Yes.
I'm very interested here in my at my desk. So thanks very much for adding some excitement to this afternoon, and thanks for joining our webinar series today. And thank you to everyone who tuned in. So have a great day, everyone. Thank you, Rob and Clay, and we'll see you on the next one.
Great. Thank
Thank you
you.
guys.
Bye bye.